Good morning from London. I'm Anna Edwards alongside Kriti, Gupta and Mark Cudmore. We're an hour away from the opening trade. Here's what you need to know. President Trump warns pharmaceutical tariffs are likely by the end of this month and chip levies could follow. Indonesia gets a trade deal, agreeing to buy more American exports in return for a 19% rate. Traders trim bets on US rate cuts after inflation data shows early signs of tariff costs feeding through to consumers. We will bring you the latest UK inflation print in a moment. Plus, ASML reports better than expected bookings as the AI boom drives demand for the world's biggest maker of semiconductor machines. But third quarter guidance looks a little light.
In the meantime, a quick check on these markets. You are starting to see risk sentiment sour just a little bit. Your stock 50 futures down about 0.4%. The FTSE 100 in the red as well, down about 0.2%. Keep one eye on the Swissy, though. This is something that is very sensitive to any news we get on the pharmaceutical sector. The idea that we might get a tariff rate on the pharma sector as soon as in 2 weeks' time, that could move the Swissy as we get a little bit more action in those pharmaceutical stocks in Switzerland. Plus, of course, the 10-year yield, as Anna was saying, off that CPI print, 4.47 on that Treasury note. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is the opening trade. Let's get straight to the breaking news, shall we, because it's moving markets. And this is in the form of the UK inflation data. Kriti, Mark, we have numbers out from the UK, and they've come in hot. So 3.6% year on year is the inflation rate. Remember, this is this is way above the target that the Bank of England has. It's above last time. It's above estimates. So both of the prior and the survey numbers were 3.4%. So this is well above that at 3.6. The month-on-month number, Mark, you pointing out that also not only is above the survey, but it's higher than last time when we were expecting a drop. So this, no surprise, is moving the pound.
Yeah, this is actually a really problematic set of data. Nothing is completely drastic, but everything has moved up, and there was meant to be a slight kind of easing of tensions there. We've seen sterling bounce in this, but I don't expect those gains to ultimately hold. This is going to be feeding into the kind of the global stress around the bond story. We're starting to see inflationary impact come through. We've seen it kind of come through in Japan this week. I've seen through the US inflation data yesterday. I think bonds are going to have a problematic day, and I think ultimately sterling's probably going to give back some of these gains over the next 24 hours, 36 hours.
So sterling doesn't hang on to gains even if we're higher for longer on rates?
No, because I think at the moment in this world where people are, we've got an inflation problem. I think there's a pressure to kind of cut rates because growth is slowing down as well. It's that stagflationary impact of tariffs. So it means that central banks are constrained from fully reacting to inflation. They can't hike rates as aggressively. So ultimately, when you've got an inflation problem, it gets people worried that they're going to undermine the real yield.
Well, it's fascinating that we were, to your point, preparing for that August rate cut from the Bank of England as well. I don't see any change in when it comes to like the actual bets of the cut itself, at least initially. We'll see if that shakes out as we get a little bit more parsing through this data. But this is significant because there's plenty of other things happening in the UK as well. We're trying to stimulate economic growth, and Rachel Reeves attempted to kind of indicate that was happening when it comes to the banking sector. TBC if that will actually have as immediate as an impact.
And diving into some of the detail here, because that might matter in terms of wage demands, it's interesting that the services number seems to have come in kind of hot. And there had been an expectation that services would actually be retreating a little bit in this particular number. So the estimate was 4.5%, and we got a CPI print of 4.7% on services. And the other thing that was supposed to be on the move and of interest is what's going on with food inflation. And I don't have quite that level of granularity, but I do have core. And core CPI year on year also rising. So it seems as if we didn't get that positivity, that drop down in services inflation that we perhaps expecting.
There's nothing positive, nothing good about this.
No, OK, that's the shortcut. That's the shortcut. Should we tie this into the wider UK agenda? Because you say this is part of a stagflation narrative.
Yeah.
So what on earth can governments do? Well, they try to pull levers around growth, and that's difficult. But we heard Rachel Reeves just yesterday trying to do a bit of that, trying to change, or suggesting she might change the ring fencing rules, which we'll remember from post-GFC were announced, although didn't come in until 2019, which kind of blew my mind today when I read that.
I hadn't realised that.
Yeah, that's a very long lead time. But anyway, the ring-fencing rules, which mean that retail savings in the UK cannot be put to work by investment banks, whereas if you're a Wall Street bank, Kriti, in the UK, you can take those retail savings that you get from UK customers and you can put them into your Wall Street sort of investment banking operations. So that's what she's trying to look at, apparently, although views vary.
We'll see how quickly that can be implemented and whether or not that actually plugs some of the gaps that you see in that budget. Let's talk about what's going on in the States, though, because the trade story is very much front and center as well. This idea that you now have a series of bad news. The market doesn't seem to be blinking as much as I frankly thought they would. Andy, you mentioned this in the headlines. Indonesia accepting a 19% tariff rate, also getting, I think, buying 19 Boeing jets in return for nothing into the United States. So I think we call that a win if you're an American. I think you don't call that a win if you're over in APAC as well. You have a tougher stance on Brazil. You have a tougher stance on pharmaceutical tariffs. That coming in, I think, earlier than expected as well. Now in 2 weeks' time, and it doesn't feel like this market feels very reactive.
Yeah, so we might get that move on Pharma. He certainly said it, as you say, that we get some kind of low tariff at the end of the month. I think from Indonesia they did get something, and that they'd had a letter previously that said their tariff would be 32%. So they managed to get it down to 19% by committing to buy energy, to buy aircraft, to buy agricultural products. This seems to be the formula, is it? You know, tariff rate in letter. Add to that purchases of US products in these three categories equals lower tariff rate.
I think that's right, and also I think things like aircraft orders take such a long time to come through. Who knows whether they actually get delivered? I think that's probably less of a problematic deal for Indonesia. Ultimately, what a lot of these countries want is certainty, and that's what we're not getting. And that's why I do think that these tariffs are going to damage. Going to your point, Kriti, as you know, for the last couple of weeks, I'm saying we're going to rally through the tariff deadline because of the fiscal tailwind. I think people have been in denial about tariffs are really going to do the extraordinary damage over the next year, and I think people are just kind of going, oh, maybe they really are going to do a lot of damage. So I think the tariff story is going to get gradually worse from here. Yeah,
one place we don't have a deal yet, of course, is Europe. I mean, there's been a letter and a 30% number being announced, but we don't have a deal yet. That'll be something that matters to all European governments, and the French government battling that as well as budget issues.
I mean, we all got excited by the 2 days holiday being scrapped, but there was a whole load of things proposed by Prime Minister Bayrou yesterday, kind of to ease up the fiscal situation in France. You know, I just don't see how any of this is going to be passed. I mean, it's funny, we're getting really, really excited with the story, but ultimately, I feel like, and maybe I'm naive here, and correct me if I'm wrong, I feel like we're just heading into another kind of government failure later on this year, another no confidence vote, because this measure of austerity just does not have the political backing. And it's just kind of like highlighting the fact that France is on this trajectory that just doesn't seem to have any natural break to it.
Yeah.
Yeah, I was going to say, this is fascinating as well, because, again, the bond market isn't blinking. And it didn't even into yesterday when we knew that something was shaking up. We knew that Marine Le Pen had already had an opening fire ready to go, that I think regardless of what Bayrou had proposed, there was going to be some sort of no confidence vote coming. Does this kick the can, I guess, down the road in September, October?
Well, we'll see if the bond market blinks in, 23 minutes' time when we get the French market, the rest of the European markets opening up. I think there is a danger, isn't there, if you're in any kind of leadership role, when you set out the difficulties and the challenges you face in such drastic terms, and yet you're not really 100% sure you're going to get your policy passed through, because you're just drawing attention. So he was talking about mortal danger, debt increasing by 5,000 euros every second in the French case. And at the same time, he does not know if he can get this deal through. Is there room for him to do a deal with the moderate left? That would seem to be something, or the more moderate left in France.
I think the problem is here is that austerity is never a good message. Populists never wants to hear we're really going to tighten the belt. But you can get away with that if you've been given a mandate to solve that problem. The problem is here, he has no mandate. He has no majority mandate. So you can never deliver austerity in that situation.
Well, we're going to get a little bit more insight in just a few minutes on this very topic. We have two perfectly placed guests to discuss that very proposal. Eric Lombard, the French finance minister, is going to be joining in just a few minutes, plus Pierre Moscovici, the president of the Cour des Comptes, France's top government audit institution. Plenty of that coming up in those conversations, plus right back to the markets. What are they pricing? What are they not? Valerie Noel, the head of trading at C's Group, will join us at the European Open. OK, let's talk about some of the other data points and releases that we're looking ahead to. 10:30 a.m. UK time. Germany will have a 30-year auction, so a lot of focus on the long end in many geographies. We will focus on that. A different story in Germany, of course. US bank earnings in focus once again. We had some numbers out yesterday. What will we hear from B of A, Goldman Sachs, Morgan Stanley? EU budget unveiling, that is scheduled to take place today. 1:30 p.m. UK time, we'll get US PPI, and 7 o'clock we get the Fed's beige book. Kriti. Absolutely. We've got maybe some early indications that tariff pass-through is starting to show up in the CPI data. Maybe more to come today. Here's what else you need to know this morning. Renault has lowered its profitability outlook for the year and named Duncan Minto interim CEO after the surprise departure of the French automaker's previous leader. Minto, currently finance chief, is taking over at a challenging time for the company. Renault facing muted demand in Europe, mounting trade tensions, and the growing competition from Chinese manufacturers. And Meta is headed for another clash with the European Union after a €200 million fine failed to bring Facebook and Instagram into compliance with a tough new digital law. The European Commission wrote to the social network giant last week, cautioning that Meta's pay or consent service, which allows ad-free services for a fee, needs further reworking. Now, the procedural step paves the way for a formal EU warning and eventually periodic fines if Meta fails to appease regulators. Sticking with the tech space, ASML's orders in the second quarter beat expectations as the AI boom drove demand for its chip-making machines. While the CEO was positive on the recent performance, he warned of increasing uncertainty ahead, adding, quote, "While we still prepare for growth in 2026, we cannot confirm it at this stage."
So we'll certainly get to the earnings story a little bit later. Coming up on the programme, the UK Chancellor then pledges to shake up bank ring-fencing rules. More on her Mansion House speech. That's coming up later in the programme. Plus, Renault issues a profit warning as autos still come to grips with the trade wars. We'll check on that stock at the market open, of course. Up next, France's Prime Minister reveals his long-awaited budget proposals. We've just been discussing them. We'll continue to discuss that in our next exclusive interview with the French Finance Minister, Eric Lombard. If you have any questions, if you want to get involved in any of these conversations, IB plus BBTV Go is the function on the Bloomberg terminal. This is Bloomberg. Welcome back. This is the opening trade. Let's get to the French fiscal story. The French Prime Minister has outlined plans to cut 2 public holidays along with spending cuts and tax rises to repair the nation's public finances. François Bayrou says the country is, quote, addicted to public spending, and he tries to tackle the euro area's largest deficit. Joining us now is France's Finance Minister, Eric Lombard. Minister Lombard, thank you very much for joining us on the programme. So the Prime Minister has set out a plan for spending cuts and tax increases. Do you think that this should be enough to reassure investors?
Yes, I think so. As you rightly said, France has an issue of a large public debt and too large a public deficit. And we are tackling the issue, I believe, very seriously. The plan is a plan of 44 billion euro of savings and revenue increases. 44 billion euro that will bring our deficit below the 5% threshold next year to 4.6%, and we are aiming at a deficit below 3% in 2029. If I can give three numbers to, yes? The 44 billion is mainly, yes?
Sorry, Minister, finish your point.
I'm listening. Yes, the bulk of the plan is to cut public spending. There are 30 billion of savings of cuts in the public spending, whether for the state or the social security, which is absolutely important but manageable. There will be 10% of revenue increases and 4 billion more because French people will have to work more, 2 days more because we will cut 2 banking holidays next year and the years after. So it's a very serious plan, 44 billion euro.
OK, and you think that this is enough to reassure investors. What about getting the support of all of the lawmakers in France? Because that seems to be very difficult. You'll need the support of a number of parties. Which parties are you going to talk to try and get support here? Are the socialists at the top of your list? Because I think the far right and the far left have already found serious problems with this budget plan.
Well, first, let me remind you that with the same parliament, we had an approval for the 2025 budget, which is currently being implemented, which is already a budget which is a very serious budget, bringing down the deficit. We will talk to all parties, because it is an issue of national interest. We believe it is the best interest of France to put its public finance right before the next presidential election of 2027. And we will talk to all parties. Having said that, the first reaction of opposition parties is quite normal because it's a huge plan, so the first reaction is negative. We will explain, we will discuss, we will improve the plan, And obviously, there are probably more possibilities to reach an approval with the Socialist Party. They are still a party in the opposition, but they allowed the budget to pass for 2025. And if we have a fair discussion with them, and we will have a fair discussion with the Socialist Party, hopefully they can support the government for the budget. But again, we will talk to all parties, and we hope to have a wider support because, again, it's an issue of national interest.
Eric, good morning. Part of the plan is to raise revenues through selling down stakes in companies without losing influence, apparently. What kind of sectors do you expect to see those kind of revenue gains? Are there any sectors off limits for selling down stakes? And how much do you expect to raise through that?
Well, obviously, you know, the French state owns many companies, some of which are listed. So I won't be very talkative on that point. So we are working on it. Obviously, the large public sector companies like La Poste or like EDF are not on the plan, but there are many options, and we will work on it.
Okay. I want to kind of, you know, ultimately, the investor community, I think the initial reaction is not a lot of faith that the trajectory of this budget plan and the government's is much better than it was, you know, 6 months or a year ago. And I think there's a lot of worry about that the government again will kind of struggle to get the budget passed and will kind of suffer on that. But we saw last year the investors move on. Are you more worried about how the investor reaction this time, or do you not think that we're yet at a critical period for investor pressure to kind of really force something to get done?
I'm not worried, but thank you to give me an opportunity to talk to them. I want first to reassure them on the 2025 budget execution. Because, you know, public finance is something which is very operational. We put a budget for this year, cutting the deficit to 5.4%, and we follow the budget execution on a monthly basis. I gather all ministers, general secretary every month, and I can tell you beginning of July, or middle of July, where we are today, that we are totally online in the review of spending. We are on plan on spending after, I must say, 10 billion cuts that we did in the first quarter and the second quarter. But after those cuts, we are totally online. And on the revenue, whether VAT, income tax, corporate tax, we are also online. So we are monitoring the execution of 2025 very closely. We have a very ambitious target for 2026. I'm confident it will be approved, it will be executed, and that France will put itself back on track, which is absolutely key in order to play our role in Europe and in the world.
Minister, it's Kriti in London. Can you just walk us through the growth numbers here? There's quite a bit of austerity baked into Bayrou's plan. Walk us through the impact on the growth picture for France.
The trajectory for this year is 0.7%, down from where it was initially, of course, because in the meantime we have the tariff war and we have the difficulties in the world. We will revise that number in September, and hopefully we will have by the time an agreement with the Americans on tariff, but we don't know yet, as you know. For next year, the trajectory for growth is to be higher than 1%, maybe 1.2%. We will clarify that also in September, with an inflation which was very subdued in the first half of the year, but for the whole year it will be probably around 1%. 1.2% maybe next year. So we wish we had stronger numbers, but that is the global situation. The positive point is for the sixth consecutive year, we are the most attractive nation in Europe in terms of investment. We get a huge investment on AI, on every type of investment in the Choose France meeting. So, of course, the main target of the government is to work on attractiveness, cutting red tapes, to make sure that we work on the growth of the economy in the coming years.
A noble effort, Minister. Talk to us a little bit about the trade point that you made specifically in terms of getting clarity on what that relationship between Europe and the United States looks like. We know in the recent list from retaliation that Brussels has prepared should there be no deal on August 1st. France is notably more exposed than perhaps they hope to be in terms of retaliation on things like drinks that are potentially exported, wine, among others. Walk us through the growth impact of that should we have no deal between the United States and Europe come August 1st?
Well, first, our key target before August 1st is to reach a deal, and we are not far. Of course, I'm following the negotiation on a daily basis. We are not far. I'm afraid that, of course, it's a decision that will be taken by the 27 member states and the Commission. If we have no deal, and if, as the US threatens us to increase the tariffs on European exports, we will have to retaliate and put ourselves tariffs, and then the impact on growth on both sides of the Atlantic will be negative. But my guess is the size of both economies, the US and the EU, is such that it's a war we cannot afford. So we are striving to get a deal.
Do you think that you have the same view on retaliation as the rest of Europe, Minister? We hear different commentary coming from Germany, for example. Will you find common ground on what retaliation is required?
I'm flying to Berlin right after this interview to align, of course, our vision with our German friends. It's customary in the EU to have a dialogue and a discussion before we make a decision, and I'm sure that jointly we will make the best decision when it comes, that is at the end of the month.
Minister, I want to come back to the conversation around trade, not just with your counterparts across Europe, but your counterparts, of course, in Washington as well. You said you're following the story or following the negotiations very closely. What is the sticking point, you think, when it comes to that relationship?
Well, I think we improved a lot our relationship. I was in Washington as soon as February. We met with President Macron, President Trump. I had a one-on-one with Scott Bessent, the Treasury Secretary. And in the beginning, we had a lot on the plate because we are non-tariffs barriers, we have tax regulations, we have the international policy relationship with Ukraine, with the Middle East, and on many of those aspects we align the position, and you've seen the NATO summit where also we put our forces together with more investment in Europe and still involvement of the US. So the last subject we have between the US and EU is this tariff issue. I must say we had made progress, but not enough. But looking at all the issues we've solved, you know, we have also solved the issue of the revenge tax, which was the section 899 of the big, beautiful bill that has been repealed. So we've cleared the way, and hopefully we'll do the same on tariffs. But I must say, at this day, is not done yet.
All right, Minister Lombard, the French Finance Minister, we thank you so much for your time this morning, walking us through the growth story and the trade story in France. Coming up on the program, going right back to what the bond market is pricing in, traders trimming their bets when it comes to Federal Reserve rate cuts after inflation data shows the early signs of tariff costs may be feeding through to customers. We're going to dive into the details next. This is Bloomberg.
Welcome back. This is the opening trade, Wednesday, the 16th of July. Let's have a look at the European equity futures picture and see where it takes us this morning. It takes us into negative territory, it would seem. Euro Stoxx 50 futures certainly expected to be on the back foot. Is this trade related? You could draw a line between some of the latest tariff news lines around pharmaceuticals, around semiconductors. You could draw a line between that and what we're seeing here. US futures, Kriti, also pointing a little bit lower. We might have some nervousness around markets as well, surrounding fiscal sustainability in various geographies, the UK and France, crucially.
Absolutely, which brings us nicely to the bond market, where I got to say it's a little bit of a nothing burger this morning. France not really reacting much, at least at the opening trade for the bond market, when it comes to the Prime Minister Bayreuth's proposal from yesterday, talking about a very scandalous topic, cutting 2 holidays from the French schedule, among a series of other austerity measures as well. We just had a great conversation with the French finance minister, Eric Lombard, talking to us about what kind of impact that would have on not only the budget, but growth as well. And he says, well, we'll find out in September.
Right. Well, he was quite keen to give this reassuring message. We'll see if that cuts through with investors this morning. But this reassuring message around 2025, Mark, which I thought was interesting, because for all the doom and gloom that we heard from the Prime Minister, all of the setting the stage for why drastic action is taken yesterday, then we had the Finance Minister with us saying, well, look, we are actually on target for all of our revenue-generating activity and the spending side of things for 2025, trying to give a slightly different message this morning.
I thought he said everything right. I mean, there's no winning situation here, because no matter what he came on and said this morning, investors are going to be cynical about this budget, and whether the government can actually get it passed, whether the government can survive. But I thought he said absolutely everything right. I would say, though, if someone tried to take 2 holidays from me, I'd be finding my gilet jaune and be out there as well. You know,
well,
holidays are
I
precious.
thought about this because one of them is Easter Monday. The French are coming after Easter Monday, and this is a cross-European concern.
You can't work with a chocolate hangover. Come on.
I know, so I feel like we should have words. That there'll be letters flying across the channel, no doubt, on that one. But just checking in on you mentioned what was going on in the bond market. It is worth saying that yields are coming down on French bonds this morning, aren't they, Kriti? So
they absolutely are.
He certainly didn't say anything to make the situation worse.
He didn't make it worse, but not necessarily better either. And we should mention that as we're talking about France, we are still 30 minutes away from the UK gilt open as well. But already it looks like traders are pairing some of those easing bets after the UK CPI number this morning.
Yeah, we're seeing some short-term gains for sterling because that. And the other big move, of course, is Japanese bonds. We've seen JGB yields come down a chunk this morning. You've got to emphasise there's so little liquidity in this market now. Valerie is going to correct me and tell me that it's the second biggest bond market
she's
in the world.
waiting to do just that.
I just know it. I can feel it. But, you know, and she's correct, second biggest bond market. But, of course, that's in free float. The volumes out there are pretty small. And we've seen, the 30-year... I mean, we're seeing moves in the long end of Japanese bonds, which, we didn't get for so many years that I've taken them all off my monitors. I've had to put them back up in the last year because I just ignored JGBs for so long. But, you're seeing 30-year yields in JGBs down 10 basis points earlier. Now they've bounced back up a couple of basis points off the lows. You can see there on the board. So across the board, we're seeing JGB yields lower. We're generally seeing a little bit of easing of tension. But the backdrop here for the global bond market is tension is ratcheting up on a slower level.
Yes, so the fact that we're seeing the French move, I mentioned yields a little lower, is that just everybody watching what's going on in Asia and reflecting that rather than the domestic politics? That would be interesting in itself. Valerie is waiting in the wings. Let's give her right of reply, shall we, and bring her into the conversation. Underlying US inflation rose by less than expected for a 5th month in June, even as the details signal companies are beginning to pass some tariff-related costs to consumers. Valerie Teitel is here. Do you want to say anything on JGBs, or shall we talk about CPI?
Well, only that the world's second largest bond market shouldn't be that illiquid, frankly, and it's having a global ramification. So liquidity problems can cause wider problems, at least for treasuries, and we know that. But let's go on to CPI. Yesterday's print was really interesting. The core CPI figure came in lower than expected now for 5 straight months, but the market seemingly shrugged that right off. We had yields rise by the end of the session. They were more focused on the evidence of a broad-based rise across the core goods basket. There were some components that had seen rises that were the largest on record. We saw even the toy month-on-month pickup be the largest in 4 years. Furniture, apparel, appliances all saw some broad-based gains when it comes to the core goods component. The good news, though, is that services disinflation is continuing. So net-net, we still got a softer number yesterday. But I think that's going to be crucial for the path ahead. Even our own economist, Anna Wong, has been writing about this. The facts that services inflation makes up 70%, 65% of the inflation basket. If we continue to get softness in core services, it could outweigh this uptick in core inflation. That's the risk on the horizon. But look, the market didn't really care about that. 2-year yields jumped. We pared back some bets when it comes to the Fed rate cut in September. We're now pricing around 50%. We did see the dollar strengthen, and I guess key for global markets, we saw those 30-year yields breach 5% as well.
I'm curious about what you think's happening on rate cuts, because I've been having a massive debate with some people on my team and some people externally about, the rate cuts priced into the market, how much risk is priced in of Powell being either forced out early or stepping down early? Because basically, to me, with an more labour market where it is, with inflationary pressures from tariffs starting to come through, the fiscal tailwind, so we're not unlikely to get a recession anytime soon, there's just no economic justification for cutting rates. So until we either get the US economy kind of careens off a cliff, unlikely the fiscal tailwind, but could happen towards the end of the year. And the other option is Powell is forced out and they force kind of undue policy. So, what probability do you think is priced into the rates market of Powell being forced out early?
Well, funny enough, this week, if you look at the poly market bets of Fed Chair Powell being fired by the end of the year, they're the highest that we've seen this year, around 30%. So maybe there is some of that priced into the market, but we're seeing that more of what's priced in when it comes to next year's Fed decision. I do still think that the 50% on September is warranted, given we do have some more labor market data to come. We even have another CPI print before the Fed convenes in September. But there's still a lot of unknowns for the path forward. I know we've talked a lot about the tariff unknowns, but there's also unknowns when it comes to how the immigration policy is going to be affecting the economy, both in GDP and in the labor market, but also in services disinflation. Something like immigration, the tighter immigration policy could show up as housing disinflation, which is a big chunk of CPI, and maybe that could net out the tariff-induced impacts on core goods.
And the fact that it's happening in kind of second-tier cities, not yet the LAs, the New Yorks, et cetera, that really, I think, creates the housing, the potential, I should say, of a housing crisis is a little bit more acute there. The other story we're monitoring out of Washington specifically is what's going on at the Federal Reserve and who the contenders around Jay Powell's gig might be. President Trump's longest-serving economic aide, at least one of them, Kevin Hassett, is one of the early front-runners to replace Jerome Powell as Fed chair. Now, it comes as Treasury Secretary Scott Bessent told us the search for Powell's replacement is officially underway.
Well, look, there's a formal process that's already starting. There are a lot of great candidates, and we'll see how rapidly it progresses. It's President Trump's decision, and it will move at his speed.
President Trump's decision, it'll move at his speed. What does that do to this bond market? Is that something that traders need to be pricing in?
Well, look, all of the candidates that are on the cards, there's been four mentioned widely: Kevin Hassett, Kevin Warsh, Governor Waller, and Scott Bessent himself. They're all very much aligned with President Trump on bringing rates lower, even when it comes to the clear frontrunner, at least from Bloomberg reporting and from the Washington Post about Kevin Hassett. He is a long-time ally of Trump. He's worked with Trump for over a decade on his economic policy. He's currently the National Economic Council directors, but he has very deep ties when it comes to conservative economic circles. He's also effective at speaking to the media. We know that's something that Trump likes. He has talked somewhat about Federal Reserve independence. He has seemed to be a supporter of it, Kriti, but he's more critical of the current Fed leadership being motivated by political reasons, being motivated by partisan interests in order to keep interest rates at this high while we're having inflation declining. But he does see Fed independence as something that is important. Now, whether the market is going to buy that, given he has such close ties to the president, some long-standing ties to the president, it's going to be another pickle for them to figure out.
Absolutely. Hassett's argument, a tough one to make in the face of potential tariff pressures coming down and showing up in the data, reversing the trend we've seen in inflation. Bloomberg's Valerie Titel walking us through those dynamics from inflation to the thinking over at the Federal Reserve. We thank you so much. And speaking of that tariff risk, let's talk about the latest on that front. President Donald Trump says he's likely to impose tariffs on pharmaceuticals as soon as the end of the month, with semiconductors also in the firing line. Our very own Jill Deeses is all over this story. Jill, can you just walk us through what these sectoral tariffs would actually look like?
Well, Kriti, at this point, we have very little detail as to how exactly all of this would come together, except what Trump is really musing here. So we'll start with pharmaceuticals. He's saying, perhaps by the end of the month. What Trump implied was that those tariffs may start at a lower rate before ultimately ramping up to something bigger over the course of the year, assumedly to give industry some time to adjust. I will point out that it wasn't too long ago that he was floating, in addition to the 50% copper tariffs that he's recently talked about, tariffs on pharmaceuticals of upwards of 200%. So, I mean, if that's what Trump is looking like as an end goal, that's pretty significant there. As for semiconductors, again, another sector where we're not entirely sure what Trump ultimately has in the works here. But the one thing that I do want to point out with a lot of these sectoral tariffs is that I think that they're significantly different than a lot of the reciprocal tariffs or those Liberation Day tariffs that Trump has been handing down country by country based on executive order, there is some, widespread belief that those might be a little bit more easily challenged, perhaps in a court or such, whereas these sectoral tariffs, which come after, lengthy investigations by the U.S. Commerce Department and others, might be more difficult to challenge. And so I think that's why there's such an interest in what happens with those types of tariffs, because as we've seen with the steel and aluminum industries, sectoral tariffs that Trump has already handed down, those can have pretty deep ramifications, even if it isn't, these country-by-country tariffs that we've been, seeing Trump try to organize over the last several months.
Jill, let's go to that country-by-country tariff story, because we've had news regarding Indonesia, and this clearly will matter a lot for Indonesia. But from a European perspective, perhaps what is interesting here is the trade-off that is required. You receive a letter. What do you have to do to get a lower tariff rate from the United States? And on that front, Indonesia perhaps teaches us something.
Yes, I think that's exactly right, because if you just kind of take, Indonesia separately in a vacuum, I mean, it's not one of the U.S.'s largest trading partners, right? I think there's something around 40 billion U.S. dollars worth of goods trade between the U.S. and Indonesia. But what you do see with this particular trade pact that Trump has announced, and again, I think we're still waiting on at least some deals from the Indonesian government to see how exactly all this shapes up. But they did receive a letter earlier this month, a rate around or north of 30%. And they were able, it seems, to negotiate something lower. I will say that, I think there's still some concerns about what this spells for tariffs globally, not just, because, not just in the sense of being able to work out something even if you've received a letter, but also because, if you pair this with the tariffs that we've heard announced on Vietnam, around 20%, do you think it kind of raises the question of whether, in Trump's mind, we're moving away from this idea of a global tariff baseline being around 10%, and maybe you're looking at something that might be positioned a little bit higher, toward that 20% marker. So I do think that that's really important in the context of Indonesia. It will be really interesting to see if over the next couple of weeks we see other countries that have been slapped with these letters negotiate lower tariff rates. But I also think it'll be interesting if you start seeing more nations, maybe in Southeast Asia, maybe elsewhere, end up negotiating tariffs that kind of fall within that 20% mark, because again, I do think that is still significantly higher than what the market may have been anticipating in terms of a global tariff rate just a few months ago.
Jill, thank you very much. Bloomberg News desk editor Jill Deasis joining us there with the latest on the trade narrative. Coming up on the programme, we'll get back to some of the earnings stories. We have a few of those for you this morning. We'll keep an eye on ASML shares. After it strikes a cautious note on 2026, the bookings, the orders, they looked fine for the second quarter, but for the third quarter and looking ahead, things look a little more tentative. This and other stocks to watch coming up. This is Bloomberg. Welcome back to the opening trade. The executive chair of Santander has told Bloomberg she disagrees with JP Morgan's Jamie Dimon, who says Europe is losing competitiveness. At an event in Ireland last week, Dimon said Europe had gone from 90% of US GDP to 65% over 10 or 15 years, adding, quote, "you're losing." Speaking exclusively to Bloomberg's Sonali Basak, Anna Botín says she sees only upside in Europe.
Most of the time, I agree with Jamie. He's done a great job. But in this case, I don't agree. And I think in Europe, the opportunity is huge, and there's only upside right now. Europe has strong fundamentals. Debt to GDP is better, strong institutions. So strong fundamentals. Second, not all of Europe is the same. Same way that Texas is not the same as California or Montana, right? Southern Europe today has higher growth than most of the United States, with very great opportunities to grow. But last and not least, in terms of relative valuation, if you look at banks, we have an ROTE as a return of close to 17%. We're trading at 8 times earnings, whereas the top 3 banks in the United States are trading with similar average returns at 12 to 14. So I think this shows why there is a big opportunity to invest in Europe, and I believe that is something which, it's not just the banking sector, it's in other sectors. Just need to choose your country, your sector, and your company.
Anna Botín, Santander's executive chair. Let's go to Kriti to find out what has caught her eye. And Kriti, I know that it is something very related to what we were just hearing about from Anna Botín.
It absolutely is. I mean, I had to fact check her, Anna. I had to fact check her on exactly just what that gap actually looks like from both two different worlds, from the price to equity perspective and the price to book perspective when it comes to U.S. banks versus European banks. And I think on this chart you can tell which segment is which. And the point that she's really trying to make is this gap between how they're trading, despite similar profitability and despite similar returns. And it's really crucial to talk about this because this gap that you're seeing in between, obviously the U.S. banks up here, the biggest European banks on the bottom, really comes down not just to kind of the returns and the profitability that you're making, but ultimately where a lot of European banks have been engaging in buybacks, in dividends, etc. This moment that you've seen in Europe, this defense spending, a lot of that is financed, of course, by European banks as well. So the point that she is making is that what you're seeing in these markets is not reflective, ultimately, of the underlying fundamentals. And if you do actually look at some of the price-to-book ratios or the ROTE, Anna Botín is not wrong. Santander is operating at a very similar level to JP Morgan, Morgan Stanley, Wells Fargo, among others. But ultimately, it is a question of this idea of whether or not the, say, Spanish or European stock market can really show the same multiples as the U.S. can, despite that profitability, and whether or not, Anna, it lasts.
A really interesting conversation there about where opportunities are and growth stories. I suppose they can both be right. Jamie Dimon can be right that Europe has missed out on growth, and Anna Botín can be right that there are opportunities in Europe. So we'll see where that conversation takes us. Let's get 3 minutes on the markets then with Mark this morning. And Mark, where do we want to start? Because we've got European stocks and US stocks called a little lower. It's easy, as we have done in recent days, to pin this on trade. There have been some kind of negative trade headlines around Pharma, but there's also the ASML numbers, which are a little tentative when we look ahead for the third quarter. I wonder what you think is most likely weighing on sentiment this morning.
I think there's two things. I think that the narrative on trade is changing. I have to say, I find how investors are talking about trade very confusing. I'm seeing a lot of people going, "Oh, maybe Trump won't ultimately back out of everything." I don't know why anyone ever thought that there was never going to be high levels of tariffs. One of the most consistent things of Trump's political career has been his love of tariffs. And he, you know, when he wasn't president, in the interim phase, he constantly talked about his regret that he did not impose more tariffs, and he was very clear that that's what he wants. You know, we did the interview last July before he got nominated. Bloomberg did the interview, and the thing he kept him going back to is he loves tariffs. He thinks they're just the best tool in the world, even when he wasn't prompted. And so, of course, we're always going to get tariffs. We just don't know what levels and against who. And I'm finding it weird that investors still don't really believe that. And I think they're still coming to a shock on August 1st. And as we get closer, they're starting to price it in. So that's a big dynamic. The fact is, though, there's another big dynamic out here, is that government debt sustainability is really, really back in focus across the world. And the whole point is it's not just one region, not just the Eurozone debt crisis. It's not just, you know, UK, where it's everywhere at once. It's US, Japan, UK, Europe. It's all the developed markets at once. And it's really problematic. Just to do a quick plug, our colleague Simon White just did the most amazing column yesterday on this, just saying, you know, a developed market bond crisis is now a serious possibility.
Maybe we should just all give everybody a pass and start over from scratch. I think it's crucial, though, that you're mentioning this trade story, because there's also a question of what is actually cost prohibitive here. If we say 30% on the European Union, how much of an impact does that actually make on the end product, especially if the focus is on the deficit and the idea is that the revenue would plug the deficit? Is that a viable thought that this world can digest 30%, 50% tariffs?
I mean, ultimately, of course, we always judge for, you know, humans are innovative and they find new solutions. It's what those solutions will be. But it's going to be extremely problematic. And what level depends on which country and which products. And that's the point, is I think it's going to be very hard to trade, because it's going to feed through in different industries and services at different rates and in different countries at different times. Which is not, there's not a binary tariff shock moment, which is what I think people are trying to trade, both in the inflation data and business. Ultimately, though, what we're going to see more of is companies are just going to, after 80 years of just getting your supply chain as heavily invested in the US as possible, because it was both the best framework for doing business, for legal side, for policy certainty, and for the consumer. The coming years are just going to be getting your supply chain out of the US. This is ultimately just going to be increasingly more expensive for US businesses to do business, and it's going to be increasingly more expensive for US consumers, because the rest of the world is going to get trade deals outside the US, make themselves more resilient. What's going to happen is other countries are going to diversify their business chains and how they kind of work. And that is why I very strongly believe that the next couple of years is going to continue to see US underperformance. That's not about being bearish to the US, it's about relative performance.
Let's see how long that sticks, or if there's some sort of reckoning come late August, early September. Mark is sticking with us for just a few more minutes. In the meantime, let's go from the macro to the micro and get our stocks to watch with Chloe Melly. Chloe.
Good morning. Let's start with the semiconductor industry this morning. We've got a little bit of a mixed bag from ASML in its earnings report. It did report orders that beat estimates in the second quarter, led by really strong AI demand. But it did flag some uncertainty in the market and said that the growth trajectory was a little bit unclear going forward. As we can see, the stock is down about 28% year on year. It's unlikely to get that boost this morning, and obviously it's not helped by the fact that that Trump is thinking of imposing tariffs on the semiconductor industry. Let's move on to another sector that is being also threatened by tariffs, the pharmaceutical sector. That will lead probably to some activity this morning. There's been some resilience in the UK stocks, GSK and AstraZeneca, but a lot of weakness in Novo and Sanofi. That's unlikely to get any better at the open this morning. We'll see how that changes the picture. And then finally, Renault reported earnings last night after the close and said that it lowered its margin and free cash flow outlook on the back of really strong competition from Chinese manufacturers and a tough auto market. It also said that it will appoint a new CEO, interim CEO Duncan Minto, who is charged now with kind of leading that turnaround.
OK, thanks very much. Our equities reporter Chloe Melly, thanks for the update. Those stocks we will certainly watch at the start of trade in a few minutes' time. We'll be back with the market open. Thanks to Mark. This is Bloomberg.
A few minutes ago until the opening trade, let's look at how we're set up for today's session. We did see a sell-off in yesterday's trading day on both sides of the Atlantic. That's what this white line is. We were doing fine about 24 hours ago, and then we definitely sold off into the close. A lot of that had to do with those Trump tariff fears as well and what the real iteration and ripple effects would look like. And you can see that the U.S. market never fully recovered. So you continue to see some pain into the closing bell yesterday. How does this set us up for futures when it comes to the European session? More pain down the road. That seems to be the sentiment, at least when you see the red on the screen this morning. But I think it's interesting here. The DAX futures are taking the brunt of the hit, down 0.6%. We, of course, have one eye, Anna, as well on the French market as well, given the commentary, the austerity that Prime Minister Bayrou is going to be trying to push through Parliament in the fall. We'll see if it comes to fruition. We'll also see if the market can digest it this morning.
Yeah, we'll watch France because of the budget story. Also, part of that, the French government looking to sell down some of their stakes, although the finance minister pretty tight-lipped on which one. So we'll watch if there's any read across from that. Another sector in focus then, Kriti, is pharmaceuticals. We've heard from the Trump administration that they would like to impose a tariff on pharmaceuticals, perhaps the end of this month, August 1st, looms large, of course. Perhaps there'll be a low tariff and then increasing it. Remember, the last we heard on Pharma was it would be 200%, but not for many months. So that's a bit of new information for the pharma sector. ASML very much in focus. The company walking back the company's growth forecast for next year due to trade disputes. So they're citing trade as one of the factors, the macroeconomic, geopolitical uncertainty, all in focus. And Renault certainly in focus, lowering their profitability outlook for the year. Also naming an interim CEO as the search for a replacement for Luca de Meo continues. Kriti?
Absolutely. Lots to digest when it comes to the opening trade across Europe. Let's take a look at what that trade actually looks like, because we are perhaps going to see a little bit of divergence when it comes to these indexes. The FTSE 100 right off the bat starting to tilt into negative territory, and that is what futures had kind of indicated as well. We mentioned France. We mentioned the EU budget as well. We should mention that, of course, the UK still also has to digest the comments from Rachel Reeves and the Mansion House speech yesterday as well. In the meantime, Stock 600 opening decidedly lower, down about 0.3%, but starting to see a little bit of optimism perhaps in the IBEX. And I think that one's interesting, given that, of course, the tariff story is likely to reflect there. We should mention a lot of the periphery of Europe has been taking an extra beating this week. So if we do see some green on the screen, perhaps retracing some of that move. To me, I think the really interesting one here is whether or not the Swiss market, the SMI over there, is actually going to react in a very big way to this pharmaceutical tariff threat. The idea that it could come as soon as the end of this month. We know that when there was talked about a carve-out between the U.S. and Switzerland trade deal, the Swiss market reacted in a very, very big way. Still waiting on the CAC 40, still waiting on the DAX to open as well, Anna.
Yes, we are not waiting for some of the big technology names to open up, or should I say down, though, Kriti, and that seems to be a really big focus for us this morning. So technology is one of the worst performing sectors this morning. We see technology stocks down by 1.2%. ASML is the biggest faller there, down by 5.8%. So it does seem, as we'd indicated, that look ahead, that third quarter guidance was hitting harder than the reassuring words they had to say about bookings in the second quarter. So as ever, the market looking ahead here. Now, the technology sector is the worst performer now. That could be overtaken, though, by autos and parts, because we have that sector kind of second to last at this point, being led by the likes of Stellantis, Valeo. Stellantis down by 3.6%. And the reason I say that it might become the worst performing sector is that Renault is halted. And we know that Renault put out a profit warning last night. They're talking about new interim CEO being put in place. Their current CFO is going to run the business in the short term, and they are looking for a new permanent CEO. But that one is halted, and we don't have a price. So we don't have a price on that one yet. But it does seem as if already that story is having a negative impact on others in the sector. As I say, Stellantis down by 3.6%, Kriti.
Yeah, it's a fascinating one. We should also mention that Rio Tinto is one of the best performers here, and we should, although I don't see any news pinned to today specifically, yesterday did see a leadership change as well. I believe it was yesterday or perhaps the day before. So perhaps a little bit of digestion around that.
Yeah, there was some we've also seen some interesting moves higher in some of the underlying commodities over in the Chinese market. But also caught my eye, Kriti, was some of the things they said about tariffs and what that's doing to some of their business over in, I think it's aluminum in Canada.
Impact,
yeah, so they talked about, they put a value on that, didn't they? They gave us a dollar figure. And what was really interesting to me was they said that they were materially able to pass that on to customers in the United States. So a lot of what they produce in Canada goes south of the border into the US, and they're able to pass a lot of that on.
Absolutely. And we should mention the pharmaceutical sector as well, at least in Switzerland, actually doing all right, which I think is surprising here. I'm looking at Novartis, I'm looking at Roche. It hasn't kind of fed up to the surface just yet, but these are not the sell-off tariff sensitivity that we are so used to when it comes to that. Shall we get a quick check on the UK gilt market as well, just as we're sticking with movers this morning, Anna?
Yeah, absolutely. Let's do that, because just as a reminder, we had that inflation data that came in really hot this morning. It moved the pound up a little bit, but not too much. And we were talking to Mark Cudmore about this in the last hour. He was saying that's because there's a limit to the extent to which, in a potentially stagflationary environment, the market thinks that the Bank of England can really fight this inflation impulse. And this inflation print was 0.2% higher on the month-on-month number and the year-on-year number than had been anticipated. So here we do see a bit of selling of the UK bond story across tenors, and we see a little bit of a lift up in the yields. But that doesn't look as if it stands out really in a European context. In fact, no, I'll take that back. Up by 2 basis points on the 10-year. Does look a little punchier than most other parts of Europe this morning. Even France, we're seeing not even up 1 basis point in France, but here in the UK up by 2.
Absolutely. We'll take it. We'll take any sort of price action. In the meantime, let's get a little bit more analysis on this trading day. Valerie Noel, head of trading over at Seas Group, joins the program this morning. Valerie, a pleasure to have you on the program as always. We're trying to make sense of all these tariff headlines. We are drinking out of a fire hose every morning. But these markets, yes, they're selling off. Yes, sentiment is dampened, but perhaps not to the same extent that they have been in previous iterations of this. How should we be thinking about the tariff threat now that we're starting to see companies on both sides of the Atlantic actually put dollar figures or euro figures assigned to the impact it's going to have?
Yes, hello. First of all, thank you for having me. It's true that you can see that the market doesn't really react now about tariff or uncertainties. I think it's part of the market. We don't anticipate the tariff. I mean, we do anticipate, but we don't. The market doesn't really react on the news until something is going to be straightforward. I think investors, I don't know, they're tired or bored of this emotion we have since April, but we can really see that the market is on hold on what actually the numbers, like earning numbers, is going to come out.
Well, speaking of those earnings numbers here, I mean, we continue to have this conversation of what the level that is ultimately cost prohibitive would be. We're also talking about carve-outs being as a key kind of sentiment indicator, as well as in if you get a tariff agreement, but then there are carved out on a sectoral basis or carve-outs for specific companies, then perhaps it's not as bad as it is. Is there a level, is there a red kind of line in the sand of what level is actually priced in to the stock 600?
Well, I don't know if there is a level, but if I join what you just said before about Switzerland and the market this morning, bear in mind that Donald Trump said yesterday that from maybe August 1st, we will know how the pharmaceutical will be not killed, but we'll know the number on the tariff. Switzerland, 30% of the Swiss market is almost pharma. And the market doesn't really react this morning. So I think it's not really about the numbers we said or imagine. It's going to be the real numbers. And until we don't have the numbers, it's very difficult to anticipate. So I think the market is just on hold for the moment on that. And this is working for pharma, but it's also working for everything else. We had too many back and forward. But now we just wait and see what's gonna be the real numbers.
Yes. So the market waits for facts, Valerie, a little bit, and those facts could come in the shape of news around tariffs, or those facts could come in the shape of profit warnings from businesses. I'm drawn to the news out of Renault this morning, cutting its margin outlook, and part of the reasoning for that is mounting trade tensions, also competition with Chinese manufacturers. Looking at this sector more broadly, do you think the auto sector is one of those that's going to feel the tariff pressure more than others, Valerie?
Yeah, I think the cars and the automobile sector, that's one of the main points between US and China. And obviously Europe, we are in the middle, but I think this is a very main point for the world right now. And as you said, we do not anticipate, that much on earnings, but when we have a bad news, actually, we can see the markets going very, very fast down. And that's also the new normal.
Right. And which of the kind of investors are you concerned about, Valerie? You mentioned in your notes that even when things look calm on the surface, that actually we're seeing a shifting dynamic around who is owning stocks or investing in stocks. You correct me on the right terminology, but the retail investor group, you say, is taking a bigger share here.
Yeah, what we have seen especially on the US market, the last 9 of the 10 weeks, we have seen institutional investors selling the market. But what we have seen from the beginning of the year is the retail investor, invest 155 billion of money on the US market. And maybe also that's why, Rachel Reeves last night said that she wished that the English people also start to invest in the UK market, because you can see that it's very, very powerful. But to come back to your question, effectively, we can see this shift that institutional investors became more cautious. And one of the main driven on the market right now is liquidity, and a lot of this liquidity are made from the retail investor.
Valerie, I'd like to specifically ask you about the defense sector. Defense, part of the pun, has also been the defensive sector when it comes to investing in Europe. Does that beget concerns around valuations when we are worried about the tariff threat, when we are worried about geopolitical risk?
Yeah, well, for Europe, it's complicated as they need to, spend more on defense. We have seen all the defense stocks are still very, very high. But I think the world of defense may change from what it was by the past. I think it's not only, army things, but we can also think defense about, robotic, about AI, about drone. And I think this is the new, when you think about defense, it's the new... It's massively different by the past with all these new sectors coming in this new sector.
Valerie, can I ask you about the London market versus markets in the Eurozone? Do you think that there's a risk that London wins out because of the uncertainty around tariffs with parts of Europe? Is that a trade that investors are talking about?
I think, the FTSE crossed 9,000 a few days ago, which I think it's a very good level. But for sure, now what the English is going to try to do is deregulation. And I think maybe, we have some equities and money coming back from to this market also. If will be better or less than Europe, I think it's also part of Europe, like Switzerland. I think you have really US, Asia, and you have Europe, including UK and Swiss market in the middle.
Valerie, can we just talk about very quickly, as a final question, what we can look forward to when it comes to the fall? I feel like light volume, light liquidity is the story of the trading day or trading season. At least in the fall, there's likely to be a lot of questions around deficits on both sides of the Atlantic, around tax increases in the UK and certainly in France, perhaps tax cuts that finally come through in the United States as well. When it comes to Europe, are taxes, are budgets the two key themes to be watching for in terms of trading Europe?
Yeah, well, it's complicated for, I think, for all government to find a balance between the taxes, the budget, invest in the stock market and everything. I think it's a challenge not only for Europe but for the US also. That's why it's the future will let us know a little bit more how we're going to be eaten. If I can say like that, but yes, it's we can see even if it's not the U.S. exceptionalism, we can see a lot of equities and stock prefer to be quote in the U.S. than quote in Europe or in the UK, and I really think that I don't know if it's deregulation, but we need to do something for a company in Europe to be quote in a European or UK or Swiss market. And not everyone, this shift moving to US.
Thanks, Valerie. Thanks for joining us. Valerie Noel, Head of Trading at Seas Group. Thank you very much for your time this morning. Let's check in on some of the other big names around Europe. We've got some interesting dynamics here on European equity markets. The FTSE 100 does outperform, but it is flat to negative, so not by a huge amount. We've got the DAX down, the CAC 40 down. Overall, the Stock 600 is weaker then by 0.3%. And these are the areas of movement. And some of the key stocks that we talk about fairly often on this programme. A bit of downside for the likes of LVMH. We have some upside, though, for Ferrari and for Nestle. Let's get a check on some of the individual stocks that are moving this morning. Chloe Melly has a breakdown for us. Good morning, Chloe.
Good morning. Let's start with semiconductors. So ASML did flag real uncertainty in the market and said that the growth trajectory was really unclear going forward. So it is down as a result of this, almost 7% this morning, and dragging down the rest of the semiconductor companies in Europe, including BE Semiconductors, STMicro and Infineon. So a wall of red this morning across that sector. Moving on to car makers, Renault lowered its profitability outlook last night after the close. It is halted at the moment, but it is dragging down as a result Stellantis and Volkswagen that are down 4% and almost 2% as well this morning on the uncertainty in the market and growing competition from Chinese car makers. Moving on to miners, so it's a bit more positive in the mining sector this morning. We had production numbers from Rio Tinto and Antofagasta, and they both upheld their guidance for production for the rest of the year as well. So that's pushing the stocks up a little bit this morning. And then finally, we have Richemont. So Richemont reported better than expected sales. That's on the back of really strong sales of Cartier and Van Cleef jewelry. And it is up almost 1%, 0.7% this morning. It has been outperforming the broader luxury sector and over the last few months. And it seems like a continuation of this outperformance from Richemont.
All right, Chloe Melly from our equities team walking us through some of those early movers. As she was speaking, we did get an opening price on Renault tanking at the open after, of course, waiting for 14 minutes for some of that volume to show up. Down over 15%. We, of course, know there's been a change in leadership there.
Yeah, absolutely. So a change in leadership. That, well, at least they've named an interim CEO, haven't they? We're still waiting for the name of the full-time CEO to take over. They've got a recruitment process in train there. But Duncan Minto is the interim CEO. He's currently the finance chief over at Renault. He's been with the business since the late 90s, so certainly knows it very well. Luca Di Maio, of course, we know is leaving. So that's part of the conversation, Kriti, is around management. But also in terms of the guidance that they're giving, they cut their operating margin guidance for this year to around 6.5%. And they've cited things that you might expect them to cite, intensifying competition. And this comes from China. And this is something we've talked about a number of times on the programme. And also the tariff environment, mounting trade tensions, certainly something that they're also discussing.
It's a shame Guy Johnson isn't here because they've also mentioned the FX story as well as factoring into their decision, also as a function of the tariff story as well. Lots to go there when you're looking at some of the other automakers. Of course, they're weaker as well, but not to the same extent. 15% and falling as we speak on Renault shares. Coming up, we're going to dive into a different sector. ASML, specifically after the company striking a cautious note on growth in 2026. Those shares down almost 7% this morning as well. Stick with us. This is Bloomberg.
Welcome back to the opening trade. We are 19 minutes into our European session that has so far delivered some downside for many of these European equity markets. The Stoxx 600 down by 0.2%. The FTSE outperforms just a little. The IBEX also actually up by 0.3%. So some strength coming through in London and Madrid. Let's go to Amsterdam, though, and talk about ASML. Shares are slumping there this morning after the company's chief executive walked back the company's growth forecast for next year due to trade disputes, even though second quarter orders beat estimates. For more, let's bring in Bloomberg's Charlotte Hughes-Morgan with some details. So, Charlotte, take us through the key takeaways from ASML today, a sort of contrast between the looking back and the looking forward.
Definitely. I mean, thank you, Anna. That's exactly what we're looking at here today. I mean, the market is clearly looking at those 2026 growth outlooks that the company has given, because actually it was quite an interesting report. You know, we had second quarter bookings, which is one of the most closely watched metrics by the market, actually beat estimates. So 5.5 billion euros came in above analyst estimates of 4.8 billion euros. So there were some positives in there. But as we see from the share price reaction today, I think shares down as much as 7% at the open. It's really clear that what the market is looking at is the 2026 and beyond situation. And actually, the CEO, Christophe Fouquet, back in the first quarter, he was saying 2026 is going to be a growth year. AI demand is going to fuel growth there. And then this quarter, the wording was a little bit more cautious. So we had him say, look, we're still preparing for growth in 2026, but actually we cannot confirm it yet. And he cited geopolitical uncertainty, macroeconomic uncertainty, and of course, tariffs.
Well, speaking of tariffs, walk us through some of the numbers. We're getting them from other major companies in Europe. What did ASML have to say on that impact?
I mean, the main message from the ASML leadership kind of echoes what they said in the first quarter, and that is that tariffs are just causing huge amounts of uncertainty for this industry. I mean, Fouquet, the CEO, talked about the direct and indirect impact of tariffs. He walked us through some scenarios in the video that came out alongside results. He's saying, look, we're preparing for scenarios where equipment and equipment parts that we ship to the US are tariffed. We're preparing for reciprocal tariffs from other nations. That's the direct impact. And then the indirect impact, you know, all this kind of uncertainty that the tariff announcements are creating is causing potentially caution among some of their customers. You know, we've already seen Intel and Samsung kind of scale back some of their spending for various reasons. And if, you know, customers turn cautious, if there isn't certainty, then of course that impacts ASML down the line as well. I mean, we have to remember ASML is the only company in the world that is capable of creating these really advanced semiconductor chip making machines. They're a really crucial part of that supply chain. And what they're basically saying is tariffs, you know, could impact their gross margins, but that they actually just don't have that much visibility at this moment in time. I mean, we've already seen tariffs on semiconductor chips. Semiconductor chips will be exempt from tariffs, but ASML is involved in making the machines, and there still is a bit of a question mark hanging over what the tariffs will be on the actual equipment used to make the chips.
All right, Bloomberg's Charlotte Hughes-Morgan walking us through those dynamics at ASML. Those shares dropping by about 7% this morning. We thank you so much. Let's go to another sector, and that, of course, is the pharmaceutical space. Donald Trump's latest tariff tirade focused on that sector, saying and warning that he's likely to impose tariffs on pharmaceuticals as soon as the end of the month. Now, Trump made the announcement as he returned to Washington after attending an artificial intelligence summit in Pittsburgh.
Pharmaceuticals will be tariffed probably at the end of the month. And we're going to start off with a low tariff and give the pharmaceutical companies a year or so to build, and then we're going to make it a very high tariff.
See a little bit more on this. Bloomberg's European healthcare reporter Tim Lowe joins the program this morning. Tim, why is there not a bigger freak out when it comes to some of these pharmaceutical stocks?
Sure, yeah, that's a great question. I mean, I think part of it is that this has been so long in coming. Investors have had months to sort of parse out the potential ramifications of tariffs. People are waiting to see concrete details and wondering when this really will go into effect. I think you also kind of see yesterday, you just played the clip. I mean, was that a real official announcement coming from, Pittsburgh, outdoors? So the investors have already sort of gamed out what some of the impacts might be. The companies themselves have sort of had a couple-pronged strategy to try to mitigate any sort of impacts that might bite. And but I think the big thing is until we have more clarity, there's not really a whole lot of smart investing moves at the moment.
Yeah, so we're waiting for more clarity. Have we heard anything from pharmaceutical companies, Tim? Because this is not the first time that we've heard President Trump and the administration talk about pharma tariffs. Of course, there's been investigations going on here, and we know that President Trump would like more manufacturing to go back to the United States. How are big pharma companies addressing that demand?
Sure, and we'll probably hear more tomorrow. Novartis has earnings. Obviously the earnings cycle is beginning. We're going to hear a lot more on this in the coming weeks. Until now, it's been a pretty, two-pronged approach, as I said. Here in Europe, the pharmaceutical companies have been, warning that this impact could cause higher drug prices in the U.S., could impact availability of some drugs to people in the U.S. At the same time, they've been hyping their investments in the U.S., a string of announcements from the big pharma players about how the tens of billions that they plan to invest in the next few years. A lot of these plans had already been sort of made prior to the Trump administration, but they're nonetheless, the companies are hyping them. And then kind of the second prong is the European companies are sort of using this as an opportunity to lobby in Europe policymakers to try to, bring about some policy changes that would make the sector more appealing here, warning that such policies could force them to, move even more so to the U.S. in order to navigate the tariffs and whatnot. So the big thing is the pharma companies until now have been very kind of opposed to a situation where there's reciprocal tariffs. One set of tariffs is bad, two sets is twice as bad.
Right, that's an interesting perspective, and you wonder which sectors, which companies does that view apply to? Something we'll continue to explore during the earnings season. Thank you very much to Tim Lowe, Bloomberg's Europe healthcare reporter. Kriti, let's quickly check on what's going on with Renault. We're now down by 17% on the French car maker. They have slashed their profitability outlook. They've taken down their free cash flow estimate to between 1 and 1.5 billion euros from an earlier projection of at least 2 billion, and it seems that all of that guidance really sticking to the share price. Also, the change in CEO, but we kind of knew that, and we're waiting to find out the name of the full CEO.
Absolutely, and the FX story, the risk of tariffs on the horizon, certainly not helping their case as well. It marks the biggest one-day drop since the COVID-19 pandemic. We're going to continue to monitor those shares. Coming up, a conversation on bank ring fencing rules here in the UK. Stick with us. This is Bloomberg. Welcome back to the opening trade. 30 minutes into today's session. And on the surface, it doesn't feel like much chaos. Down 0.3%. Sentiment certainly souring just a little bit, but a little bit more action underneath the hoods when you talk about the likes of ASML, Renault, even some of the pharmaceutical sectors, not really bubbling up to the index level just yet. Let's bring your attention to another sector we're keeping an eye on. That, of course, is banking. Another batch of the Wall Street's biggest lenders are set to report this second quarter earnings morning. JP Morgan's investment bankers had a surprise gain after the firm's stock trading desk delivered a record second quarter yesterday. While speaking on the call, JP Morgan CEO Jamie Dimon said he's in no rush to buy a private credit firm.
You may have seen peak private credit a little bit. I've mentioned that credit spreads are very low. It's grown dramatically over time. And, you have to pay up a lot for it. I'm not saying it's not going to grow some more, but I would have a slight reluctance depending on who it was.
Charlie Wells is here with the latest. Charlie, just walk us through what we learned yesterday and how it's setting the stage.
So one of the issues that really came through is that deregulation or changes to regulation take time. And I think that this could change a little bit of the narrative that we've been seeing in this banking rally over the past few weeks, where there's been a lot of excitement about deregulation, a lot of excitement about maybe lighter capital rules for these banks. But you had some executives sort of pleading for patience here. And I think Wells Fargo comes into focus when we're thinking about this. This was the first quarter that they were able to report without that Fed-mandated asset cap. And a lot of investors had been really excited, had been really looking to see what might happen. But Charlie Scharf, the CEO of this bank yesterday, basically saying on a call with analysts that that asset cap removal is not like turning off a light switch and suddenly everything's going to change. So that is one of the themes that really came out here. And, you know, you also really saw, interestingly, from Citigroup, a $4 billion buyback that really moved the share price in a different direction, really moving it in a positive direction, highest point since 2008. Speaking to another big theme, it's what are banks in a lighter capital regulatory environment, what are they going to do with it? Buybacks in this case.
Yes, and is that going to be a theme of today? Because, fine, that's all yesterday, isn't it? Water under the bridge, Charlie. Let's move on to today's numbers. Goldman Sachs, Morgan Stanley, Bank of America, all reporting today.
You mentioned Goldman Sachs, you mentioned Morgan Stanley, and that brings me to what we heard, of course, from JP Morgan, which was the surprise beat in investment banking. You know, beating expectations by 23%. That adds pressure to these banks which rely more on investment banking for their business models. They're expected to show growth, but I think any misses here could really, you know, be negatively interpreted by the market because that is really so in focus. Bank of America, also an interesting one, right? Its shares are up about 5% this year, trailing peers. And I think the question here, there's been a lot of, you know, analyst commentary here about how maybe the market is not pricing Bank of America right. I think the buy ratings here are about 75% of consensus. Maybe it's a little bit mispriced. Its business model, of course, is a little bit more similar to, say, the Wells Fargos or the JP Morgans of the world. So this earnings report is really important here to show, you know, how the market really reacts to this, what they think about that business strategy.
Jamie Dimon has been very vocal of the strength of the American economy, with a caveat, with a disclaimer of things could be worse to come. So is Brian Moynihan. So is a series of these folks. What do we take away in terms of where we are from an economic perspective?
This was a marked change from the prior quarter when there was so much negativity, when there was a lot of talk about the uncertainty. You saw these comments coming from Dimon, of course, about how now that we've got more clarity on the tax front, that could be beneficial for the economy. Jane Fraser, interestingly, also had some really, you know, positive comments on the American economy, talking about the strength, talking about how it's exceeding expectations here. And she also mentioned the strength of the consumer. And so, again, we're seeing consumer strength here. There had been concern about, say, loan loss provisions. I think Bank of America in particular should give us more of a lens on this when they report in a few hours.
OK, well, watch out for that. Charlie, thank you very much. Bloomberg's Charlie Wells with the latest on the banking sector. So the bank earnings story continues to be in focus over in the United States. Here in the UK, traders are trimming bets that the Bank of England will provide rate cuts as UK inflation unexpectedly rose this morning, or in data released this morning, to its highest level since January 2024. This, as the UK Chancellor of the Exchequer, Rachel Reeves, has pledged to reform the UK's bank ring-fencing rules to help spur economic growth.
I have committed to meaningful reform of the UK's ring-fencing regime, recognising that now is the time to go further in tackling inefficiency and boosting growth, while retaining the aspects of the regime that support financial stability and protect consumer deposits.
For more, let's bring in Dan Hansen from Bloomberg Economics. Good morning, Dan. Lots to talk about then. We've had the CPI print out this morning. We've got these ring-fencing rules. What can that do, from your perspective, I suppose, for the growth agenda in the UK? Should we start with the CPI numbers? Because those did come in higher than expected. And, you know, I remember times gone by where that might have led to a really big push-up in the pound because people would expect, you know, that we'll have higher rates for longer. We've seen a tiny bit of that, and the pound's up 0.1%, but not much. Does that reflect a nervousness that actually the Bank of England won't be able to do too much to fight inflation because of downside growth risks?
I think that's absolutely right. And actually, I think the way the Bank of England has been communicating, particularly recently, is that there's much more focus on the labour market. And actually, it might be that tomorrow's data is more important. And if we got a surprise there, that might prompt a bigger change in market pricing. So I think, you know, you're right. There was a time where a 0.2 percentage point surprise on CPI would send the markets into a tailspin.
Because this is way above the target, isn't it? We're still above 3.5%.
And I think that's what the news is today, is that we are close to this threshold of 4%, which the Bank of England has cited as a level that households and businesses get a bit more sensitive to inflation. So I think what this does is it tells you that if you're going to get rate cuts, they're still going to be quite slow. And the Bank of England's been cutting rates at a quarterly cadence. I think it seems very unlikely to me at this stage, and sitting here right now, having seen that print this morning, that they're going to go any faster than that. But I don't think it stops them lowering rates further. It's just that it's going to be a slow burn, and they're going to move slowly down. And I think you'll probably get one, maybe two more cuts this year.
Talk to us about the other side of this, which is Rachel Reeves and what she had to say around the bank's ring fencing rules. How much of the game does that change?
I look at this sort of on two sides. I do worry, because if you look at the Andrew Bailey argument on this, is that this may not be that positive for growth because banks may not end up lending as much to households and businesses, and so you get a lowering in quantities of lending and a rise in price of lending. So that's obviously bad for growth. For me, if you want to do this, make this move towards taking more risk, and I do think this is the right thing for the UK economy. I think there is an issue around risk-taking. It might be a little bit more on the fiscal side. Now, we know there are constraints on the fiscal side, but I do think it might be a better lever to pull might be on taxes in terms of giving firms incentives to start up and innovate. The concern I have with this is there is a clear link between financial stability and changing the ring fencing rules, and we learnt the lesson in the financial crisis about this. So I'm a little bit worried about that interaction, and also whether it will give the meaningful lift to growth that we've all been expecting, because it feels like the government has had lots of different ideas about growth and different things, and they haven't really found that silver bullet yet.
Right, and let's wait. I suppose we have to wait and see what they really mean about looking at the ring fencing rules again and what change they'll bring about, because on the one hand, you know, at the one end of the extreme you could scrap the ring fencing rules entirely, and at the other end you could just change the amount to which, or change the extent to which banks in the sector are able to share services between the international and the domestic, which probably doesn't impact growth that much. It might help the banks be more profitable, but isn't necessarily something that would show up on your radar. I suppose let's focus on the fiscal side of things. I mean, update us, Dan, after all of the attempts they have made to give themselves more fiscal space, and yet they come up against a brick wall, it seems, on a number of occasions, certainly most recently with the welfare cuts that they were trying to bring about. I mean, how tight is the fiscal situation in the UK now?
I mean, it feels like we're in Groundhog Day, doesn't it? Every 6 months we have this conversation about the headroom, about fiscal space, and it boils down to the fact that growth just has been really, really weak. And if you get stronger growth, you get stronger tax receipts, and the world is just an easier place when it comes to setting fiscal policy. I mean, I think going into this budget, it's going to be another very, very difficult budget. Perhaps not quite as difficult as this time last year, but I think there are some difficult choices to be made. One thing I'd say about this, and one thing we always make the point to clients about, is that this was something, it feels to me at least, something that was coming for a long time, because the big source of fiscal deterioration is around the OBR's forecast and the possibility that they've been very optimistic and they downgrade their forecast. And it feels to me like that was something that was coming no matter who won the election last year. But it's obviously a problem that wasn't surfaced in the October budget last year, and it now means that Labour are going to have to deal with it this year. I mean, the U-turns they've made and the other changes, they're relatively small. They add up to about £6 billion. That's something that you could fix quite easily. Changes to the growth forecast, they're big numbers. That's sort of £10, £20 billion in terms of the fiscal deterioration. So a lot depends on what the OBR will do. It's very hard to know that, but if they do make a change that brings their forecast closer to consensus, that's going to be a big fiscal hit.
And we've seen, Dan, the French put out a budget overnight, and there is mention in there of higher taxes on the wealthy, and that's been a conversation in the UK as well about where taxes are going to go up, if taxes are going to go up, and a lot of people saying it's a question, I think you even said, it's a question of when, not if. I mean, you can see where this comes from post-COVID, with finances stretched in many areas, but there have been warnings in the UK that if they do that, that might not have the impact on well, it won't have a positive impact on growth, and really that's the underlying issue.
Absolutely, and I think this is the massive challenge, that it looks to me like Labour isn't willing to have a conversation about spending, and we found that found that out with around the welfare issue, that it's really hard for them to cut spending. It seems really hard that they're going to cut the NHS budget, and they're the two big bits of the spending side. So it does come down to tax. And the question then is do you go down the sort of, as you mentioned, wealth taxes, so CGT, capital gains tax, inheritance tax, or do you go down the route of income tax and national insurance contributions? And obviously that comes with political risk because they've committed not to raise those things. I do feel, though, that if, just to square the circle, you can't borrow more, you're not willing to cut spending, that only leaves you with tax. And if you want to raise a lot of tax, you have to go for something that has a wide tax base and a fairly sort of unmobile tax base. Wealth taxes, they're very mobile, the tax bases. Yeah. We've seen that with the non-doms. So if you went for CGT or tried to bring in a wealth tax, the worry is that it just wouldn't raise the money.
So more fiscal drag? Is that what we end up with? That's
the first thing.
Yeah.
And then I think there is definitely a conversation to be had about tax rates around personally income tax and also national insurance.
OK, Dan, thank you very much.
No
Thanks
problem.
for the input. Dan Hansen from Bloomberg Economics with thoughts on Mansion House, the UK CPI and the UK fiscal landscape. Coming up, we'll pivot back to that French politics story that we just talked about. France's Prime Minister plans to cut public holidays along with spending cuts and tax rises to repair the nation's public finances. We'll discuss all of that with Pierre Moscovici, the President of the French Court of Accounts, the Cour des Comptes. This is Bloomberg.
Je crois que c'est la dernière station.
This is the last stop before we hit the cliff and are crushed by debt. It must be called by its name. It is a mortal danger for a country. For over 20 years, I have identified this risk, making it the subject of several presidential campaigns. And that chance, or destiny, which is another name for chance, has entrusted me with the task of addressing it for the country at this critical moment in our history.
Notre histoire.
The French Prime Minister outlining their plans to cut 2 public holidays along with spending cuts and tax rises to repair the nation's public finances. Francois Bayrou saying the country is, quote, addicted to public spending as he tries to tackle the euro area's largest deficit. Joining us now for an exclusive conversation, Pierre Moscovici, President of the Cour des Comptes, otherwise known as the French Court of Accounts. We thank you so much for your time this morning. Let's start off with the announcement from yesterday. Is this enough? Is this enough to get the budget under control, to get the deficit under control in France? Your thoughts?
Well, we have one of the largest deficits in the Eurozone, maybe the largest. Our public debt is too high, and the Prime Minister is right to say that this is a mortal peril. I think that the announcement yesterday are up to the expectations because we will cut some 44 billion euros in order to reduce our deficit significantly and move forward in order to control our public debt. This is not something that is doable in 1 year. This will be an effort for 5 years. We must be under 3% in 2029 at 2.8%. We start from 5.8. So this is massive. The question is, how will the political forces in France react? Because we need to find a compromise in the parliament, which is hung without a majority. And, well, these measures are quite ambitious, as a matter of fact. I'm not going to comment on them to say they're fair or not, because I'm not a politician. But let's say that the size of the effort is up to the needs.
You say it's up to the needs, but you formally said, or French Court of Appeals has Accounts, has formally said that the required adjustment in the budget to get to that 3% deficit target for the EU requires something like 105 billion euros. The budget austerity that Francois Bayrou is targeting is not of that amount. It's somewhere between 40 billion euros. Where do you think that gap can come from?
No. When I mentioned 105 billion euros, I mentioned the effort that needed to be done structurally to get to under 3% in 2029. That means that we must have a structural effort of some 20 to 25 billion euros a year. And if you, it's complicated because it's due to some calculations that are not simple to describe. If we have 44 billion euros spending cuts, plus taxes, or 44 billion as a whole, then we are on track to get there. It's the first step. But we will need to build a trajectory from that, which is credible. And this must be said and also defended towards the European Commission, because we are in a deficit procedure, towards the markets, towards the rating agencies. Those people who are creditors or the people we belong to as a union must know that we are credible and that we are really dedicated to control our public finances, to take back control of our public finances. I think this could be a first step. But again, let's not be mistaken. We are at an early stage. The budget law will be sent to the Parliament on the 1st of October. And there will be a lot of discussions because, again, one must take into account politics. And the French politics are complicated since this government has no majority, since the Parliament is hung, since, you need to find your way into 11 political groups in the Parliament. And this is just a start to enter into the debate. But if you consider the size of the effort, it's a good start.
OK. Good morning to you, Pierre. We've already heard from the far right and the far left that they don't like what they've heard, and maybe that's no surprise to anybody. But do you still see a path forward for this budget? If the socialists, for example, can be brought on board just as they were for the 2025 budget, is that the most likely way that this budget gets approval?
Well, as you said, there is a path, but this path is obviously narrow, since the support of the government is no more than 200 MPs with a majority that is 290. So obviously the government must find some allies, or at least some groups that don't vote against the budget. And this is why I said this is a start, because it's likely that will be changes in the budget. And this is legitimate after all. You can say that you have more taxes, or that you have more spending cuts, that you have this effort or that one, and this will be the building of a compromise. Obviously, the government needs to build this compromise. His proposals are now on the table, and I think a discussion will start. So the budget that will be voted in the end, hopefully, might be somehow and even likely very different from this one. But again, what is important is that the target is the right one. We need to make such effort. Nobody can accept that we have any more deterioration of our debt.
OK, and the trade story, of course, globally. Right, and of course the trade story continues to evolve, Pierre. We spoke to the French Finance Minister, Eric Lombard, earlier, who shared his view on the timeline for a trade deal between Europe and the United States. Let's have a listen to what he said.
Our key target before August 1st is to reach a deal, and we are not far. Of course, I'm following the negotiation on a daily basis. We are not far. I'm afraid that, of course, it's a decision that will be taken by the 27 member states and the Commission. If we have no deal, and if, as the US threatens us to increase the tariffs on European exports, we will have to retaliate and put ourselves tariffs, and then the impact on growth on both sides of the Atlantic will be negative.
Pierre, could you help us understand when Europe should think about retaliation and when it should not? Business views might vary on this subject as well. Political views will vary. Should we think about this as a 10% tariff means no retaliation from Europe, a 30% tariff means there will be retaliation, and what would you say to 20?
Well, in my previous life, I've been a EU commissioner. I'm not anymore. I've been also a finance minister. I'm not anymore. So Mr. Lombard is well aware of the discussions as they are. But what I know from my experience at the Commission is that obviously the Commission is already preparing retaliation, not because it wants to retaliate, because you need to have a plan B if you don't get to your plan A. Obviously, the plan A is to have an agreement with the US administration before the 1st of August, in some 2 weeks from now. And I think, of course, this is the best case scenario, because trade wars are silly. They are destroying the economy, they are destroying growth on both sides of the Atlantic. I don't think this is the right way to approach neither growth, neither enhancing your local or domestic production. But if it's not possible, of course, the EU will have to retaliate. We are not naive. We are a goodwill union. We want an agreement. We think that the US are our partners, our allies. We think that trade wars are silly, but of course we need to be prepared to respond in case there is no availability to get to a good agreement, not only to an agreement, because we cannot we cannot accept that we have such high tariffs.
Pierre, thank you very much. Thank you very much for joining us. Pierre Moscovici, the president of the French Court of Accounts, the Cour des Comptes. Thank you so much for giving us your perspective on French fiscal sustainability and the trade conversation. Let's get a quick check on some of the companies that are on the move this morning. And we should stay in France, Kriti, when we mention Renault, because that stock is down by 15.4% right now. The company has changed the CEO. We knew that, but they brought in the interim. The CFO has become interim CEO. We'll wait for an announcement on the permanent CEO. He or she will have a host of issues to contend with, not least of which the tariff environment. Even for a business that doesn't produce in the United States, this is still an issue for the sector, of course. And the competition from China, something that they've also cited in the profit warning that they put out.
Absolutely. Speaking of China, we should talk about what's going on ASML as well, because the picture isn't exactly rosy there either. The shares are dropping this morning. However, we have just gotten commentary from the CFO of ASML saying that lifting the Chinese chip controls would boost demand. The Chinese business is still fairly healthy. This, of course, follows some of the announcements from both NVIDIA and AMD that we've seen in the last 48 hours in terms of actually allowing some of those exports to go from the United States into mainland China and ultimately Hong Kong as well. Nevertheless, ASML, from a stock perspective, their guidance was not as great as expected by global Wall Street, down about 7% this morning.
Yeah, absolutely. So it's that third quarter guidance that was lighter than the market had been anticipating, and so that's the negativity that sticks to the stock rather than the bookings story, which was more positive in the second quarter. It was interesting on the NVIDIA story, though. Even NVIDIA themselves, they don't know, when exactly they're going to be able to send these H20s back into China. This was the story we talked about yesterday. They've not actually received that license yet, and crucially, they don't know how many. So just what exactly is the makeup of this lifting of these chip export restrictions? We'll keep that in mind. So those are a couple of the stocks we're watching this morning, ASML certainly, and Renault. Coming up on programming today here on Bloomberg TV, a conversation with the chief executive of the Italian bank, Monte dei Paschi. You can catch that on the Pulse. That is coming up next. It is Kriti 8:56 here in London. European stocks on the back foot, down by 0.2%. London outperforms just a little. The Pulse is next. This is Bloomberg.